Good morning, everybody. Lovely to have you join us for our next webinar, which is fantastic. I apologise for being a minute or two late. There's quite a storm here in Western Australia for those of you that aren't here, so it's all my fault, but we're very fortunate to have Kelly join us. I would like to start first by acknowledging the traditional owners on the land of which we meet today, the Whadjuk Noongar people, and pay our respects to elders past, present and emerging. And this is a special week as well because it's Reconciliation Week. And for people working in energy, I think this creates a real opportunity moving forward for First Nations people here in Australia to think about the opportunities. But today we're really fortunate to have Professor Kelly Shue, who's going to talk about counterproductive sustainable investing. And I won't spend too much time, but I did just want to introduce Kelly or Professor Shue. Her interests lie at the intersection of behavioural economics and empirical corporate finance. And her research has explored the Peter Principle, compensation and promotions, gender and negotiations, the gambler's fallacy, contrast effects, and non-proportional thinking in asset pricing executive social networks. And I think the focus of I'm really excited to have Kelly here to talk to the Australian audience, but obviously there's probably some international dialing in as well. Because I think when I listened to Kelly's work before, it really sort of challenged my thinking and reinforced some of the things that I see. So the way that we're going to run it is Kelly will talk for about 20, 25 minutes or a bit more. And then obviously we'll open up the Q&A for people to put questions in there. So Kelly, without further ado, I might hand over to you and I'll leave you to share your thoughts. Thank you.
Okay, well, thank you very much, Peter, for the very kind introduction and for this opportunity to share my research and have a discussion with an Australian and broader international audience. So let me share slides, and then hopefully you can all see this. Please interrupt me if you don't. Great. So today I'd like to share with you some recent research that I've been working on with Sam Hartsmark at Boston College. And our work is about how the dominant sustainable investing strategy could actually be counterproductive to an environmental goal. Okay. So let me start by remarking that while there is significant heterogeneity across various types of sustainable investing strategies, the most popular form, so that's what we're going to call the dominant strategy, that generally seeks a green transition. So the goal of many of these sustainable investors is they want to reduce firm greenhouse gas emissions intensity, and they're hoping to do so while minimizing the disruption to economic output. Again, there is significant heterogeneity across strategies, but the dominant implementation is quite simple. It's various funds that call them itself ESG, green, sustainable, climate-oriented funds. What they do is they buy green, or so that's basically environmentally friendly, low carbon emissions firms, and they divest away from or underweight brown firms. So those are the high polluting, high greenhouse gas emissions firms. Now, we very much want to acknowledge that alternative strategies exist. So, for example, you could have an engagement strategy, or you could do targeted investments in green R&D that are project specific. But these alternative strategies really represent a very small percentage of the overall $40 trillion globally that can be categorized broadly as ESG, climate, or sustainable. Okay, so to clarify, to the extent that what I'm about to present is critical of sustainable investing, it's really a critique of the way that the dominant sustainable investing strategy is implemented. It's not a critique of these kind of alternative strategies, which I'm personally fairly optimistic about. So let's talk more about whether the dominant sustainable investing strategy is going to achieve its green transition goal. The proposed mechanism is that the sustainable investors hope to make firms more green by changing around their cost of capital. Basically, if we're sustainable investors, we're going to direct our money, we're going to direct our capital toward green firms. That's going to lower their cost of capital, make it easier, cheaper for them to raise financing, do more of that green stuff that they do. And also, we're going to direct our capital away from brown firms. This is going to raise their cost of capital, basically make it more expensive for them to invest, push them closer toward bankruptcy, and essentially punish these firms. And what we ask is, what do we expect will happen if sustainable investing succeeds in changing the cost of capital under this dominant strategy? Will it actually achieve its green transition goal? And what we argue is that, the outcome depends on each firm's impact elasticity, which is the firm's change in environmental impact for a unit change in its cost of capital. And we're going to measure that separately for brown and green firms. Now, before I get to a summary of our actual empirical results, let me just walk you through an example of what we have in mind. Okay, so let's consider a typical green firm. This is Travelers Insurance. This is an S&P 500 firm in the insurance industry. Now, this is a firm with very low emissions intensity, so it only pollutes 1 ton of greenhouse gas per million revenue. Okay. This is also a firm that has cut its emissions intensity by an impressive 40% over a recent 3-year period from 2019 and 2021. And this firm has a long-term goal of becoming net zero by 2030. And I would say this is a firm that has a credible path toward actually becoming net zero by 2030. Okay. Now contrast that with your typical brown firm. This is Martin Marietta Materials. This is another S&P 500 firm of approximately the same size, but it produces building materials. Okay. So this is a firm with much higher emissions intensity. It literally produces 1,000 times as much pollution per million revenue. Okay. This is a firm that has cut its emissions intensity by about 12% over the same 3-year period. Now, 12% sounds less impressive than cutting emissions by 40%. But I just want to note that this 12% cut in emissions by this brown firm is actually far better for the environment, because this is the firm that started out at 1,000 times the level. Okay, and this is an issue that I'll return to later. Martin Marietta Materials has the long-term goal of reducing emissions, but it does not have a net zero pledge. Okay, so its long-term goals are more modest, and it discusses this issue that moving toward clean production is really costly up front because it needs to buy new machines and invest in new production methods. Okay, so let's consider how the dominant sustainable investing strategy interacts with these firms. Basically, and we've actually verified this in the data, sustainable investment portfolios tend to buy services firms like Travelers that have very low emissions, and they avoid or underweight energy and manufacturing firms such as Martin Marietta. Okay. Now, what we highlight is this strategy can be problematic because if you reward Travelers Insurance as an insurance firm, it really cannot get much more green or brown as its cost of capital shifts around. Okay, suppose we were to decrease its cost of capital towards zero. Okay, basically it's going to grow and offer more insurance. It could potentially achieve, let's say, a 100% reduction in emissions, but because it started at close to zero emissions in the first place, that matters about as much as Martin Marietta cutting its emissions by a mere 0.1%. Okay. The other problem with providing basically rewards and incentives to services firms such as Travelers Insurance is it's not going to basically leave its industry, right? It's still just going to provide insurance. So it's unlikely to use that cheap access to capital to produce building materials at a lower emissions intensity compared to existing manufacturing firms. And also, as an insurance firm, it's unlikely to use this cheap access to capital to meaningfully conduct green R&D that can spill over to the production processes of other firms. Now, consider instead Martin Marietta. Because it starts at such a high level of greenhouse gas emissions, this is a firm that could really become much more green or brown as its cost of capital shifts around. If we were to reduce its cost of capital, that makes it more attractive for this firm to invest in the expensive green technology that could pay off in the future. However, if we were to punish this firm by raising its cost of capital, that effectively makes this firm more short-termist. It has an incentive now to try to get cash right now in order to avoid bankruptcy. So it now has an incentive to cut corners or double down on existing Brown production in order to get that cash up front. And this could actually be quite detrimental for the environment, because if this firm were to reverse just its recent reduction in emissions over the past 3 years, that would amount to an increase in greenhouse gas emissions equivalent to 30 times the entire annual level of emissions for travelers insurance. So what I have illustrated here is not just these two firms. It really reflects a general scale difference in the extent to which different types of firms matter for the environment. So here what we're doing is we're looking at approximately 3,000 firms over the past several decades, and we've divided them into quintiles in terms of their emissions. So brown is quintile 1, green is quintile 5, and firms in the middle 3 quintiles, we're classifying them as neutral. So first I want to just point out that brown firms have about 1,700 times the total emissions of green firms. You might think this could just be due to differences in firm size, so maybe just larger firms pollute more. But after we focus on emissions intensity, so this is emissions scaled by revenue, this is like a emissions per unit of output, we still find that the average brown firm has 261 times the emissions intensity of green firms. And notice the firms in the middle 3 quintiles are much closer to being green than they are to being brown. So this just tells you that there's a handful of firms in a handful of industries. Basically, the industries are energy, transportation, manufacturing, and agriculture. These are the firms that really matter for the environment in terms of emissions. We don't really need to go around incentivizing other firms to improve very much because they pollute so little already by the nature of their business. We need to concentrate our incentives on this group of brown firms. Okay. Now let me summarize our measures of the impact elasticity. So impact elasticity, recall, I'm defining as the change in a firm's environmental impact as measured by its emissions for a change in its cost of capital. So essentially what we do in our paper is to examine how firms' emissions intensity have responded to shocks to their cost of capital using data across about 3,000 firms over the past 20 years. Okay, and what we found is historically, when cost of capital has gone up, and we can use different reasons for why the cost of capital has shifted around. Our preferred measure is a shock to dividend demand. So let's say there's a time period when people just love dividend paying firms, then those firms have cheap access to capital. We look at how their emissions changes. We can also look at financial distress shocks. So this is, suppose there are firms that vary ex ante in how much debt they have. Then suppose there's a negative industry level productivity shock. Well, that's going to hurt all firms, but it really hurts the firms that have high leverage already because now they're dangerously close to bankruptcy. So they're going to get a really high cost of capital shock. So using these variations in cost of capital, what we find is that green firms have impact elasticities very close to zero. So historically, when their cost of capital has moved around, their environmental impact has not really changed. And I think that's not that surprising because they start out at close to zero environmental impact anyway by the nature of their business, okay, model. On the other hand, we find that brown firms have quite negative impact elasticities on average. So basically, they actually pollute more per unit of output when their cost of capital goes up. Okay, so I've summarized actually a big part of our paper very briefly on the slide. So if you're curious about our detailed estimates, I would encourage you to explore this link here. But for the purposes of this short presentation, I really want to talk more big picture about why this could be happening. Okay, so why do brown and green firms have different impact elasticities? Well, what we imagine is happening is that brown firms can choose between two types of investment strategies, okay, or business strategies. The first is they can continue existing brown production and cut corners on pollution abatement efforts. This is how they get a lot of cash right now, okay? On the other hand, they can shift toward new green production. This has a higher upfront cost because they need to get new machines, invest in new processes. It could actually still be good for their business, but it would deliver backloaded cash flows instead of cash right now. Now imagine that the cost of capital goes up for these brown firms. That's equivalent to them having a higher discount rate. Okay, basically they value the future less compared to the present. Okay, so short-term cash flows are going to look more attractive, which is going to cause them to favor option one, which means they're going to pollute more as their cost of capital goes up, and essentially they have a negative impact elasticity. So you can think about our research as really pointing out this contradiction in the dominant sustainable investing strategy. Essentially, sustainable investors want brown firms to behave as though they care more about the future. But what they're doing by punishing these brown firms is they're raising their discount rates. Okay? And that actually makes the brown firms care less about the future. Okay? Contrast that with green firms. Green firms tend to be in services industries such as insurance, financial services, or healthcare. Basically, by the nature of their business model, they cannot generate large environmental externalities, regardless of which investment or business models or strategies are chosen. Okay, so therefore, they're going to have impact elasticities pretty close to zero. We also carefully considered the possibility of additional incentive effects. So one of the reasons why sustainable investing could be successful is this idea that there's an incentive or carrot, right? What if brown firms choose to become more green in order to access a lower cost of capital or higher share price from sustainable investors in the future, right? So we think this is very promising in theory. However, when we look at the data on the aggregated holdings of sustainable investing funds, we showed that so far sustainable investors have offered very weak financial incentives for brown firms to improve. And that's because what we find is that sustainable investors primarily only reward firms that are already green for large percentage, but environmentally meaningless reductions in emissions. Okay. So again, the detailed analysis is in the paper. Let me just show you some I think, salient examples. Okay, so this is the Financial Times Climate Leaders list for 2022. And notice the ranking of who are the climate leaders is in terms of percentage reductions in emissions intensity. Okay, if you look at the actual level of emissions for these so-called climate leaders, they all have levels of emissions below 15 tons per million. Okay, so these are firms that, up to some rounding error, essentially don't pollute to begin with. Okay, and they're basically going from close to zero to even closer to zero. Okay, contrast that with your typical brown firm that's starting at several hundred to 1,000 tons of emissions per $1 million of revenue. Okay, so for those firms, if they achieve even, let's say, a 5% reduction in emissions, that's actually much better for the environment than the, let's say, 46.8% reduction here. Okay, so it's this problem that sustainable investment criteria as well as ESG ratings are rewarding changes in emissions in the wrong units, essentially. The other problem we point out is a lot of the divestment choices and exclusion criteria is operating at the company level based upon the sin of ownership, rather than what the company is doing with carbon assets or whether the company is pursuing individual green projects. Okay, so consider this influential list. This is called the Carbon Underground 200. And it's a list of the 200 coal the top 200 coal and oil and gas reserve owners in the world. And the idea here is you should find out if you're invested in these 2,000 of the largest owners of carbon reserves. And if you are, you should kick them out of your portfolio. I think that's the general idea. The problem with lists like these is it offers the current firms that own these carbon assets almost no incentive to improve how they're using these assets in terms of environmental impact. Instead, what it means is public investors don't want these firms in their portfolio. These firms now have an incentive to sell off these carbon assets to private owners, okay? But just because investors and firms have divested themselves of these carbon assets does not mean that the carbon asset disappears, okay? They've just transferred toward private ownership, and it's potentially even problematic because the new private owners could operate these assets and use these assets in an even less environmentally friendly way. Okay. Finally, I want to talk about this idea that perhaps the dominant investment strategy can shrink brown firms and facilitate a green transition in that way. Okay, so the evidence I've shown you so far says that the dominant strategy causes brown firms to increase their emissions per unit of output. Okay. But, if we were to kick up their cost of capital or their financing cost toward infinity, it does mean that these brown firms, while they might get more brown per unit of output, they're still going to shrink and eventually die, and they're not going to pollute anymore. And it also means other firms will not want to enter and replace them because they're going to face the same fate. Okay. My personal take is whether you want to pursue this type of strategy really depends on whether you believe there is a good substitute for the types of output that you're trying to shrink or kill. Okay. Depending on which country you're in, there might be a very good substitute for coal-related power. So maybe we're okay with trying to shrink and kill off coal. Okay, but more generally, it could be hard to substitute away from, in general, agriculture, energy, transportation, building materials. So those are the brown industries, and just consume more insurance, healthcare, and financial services. Those are the green industries. Okay, so let's talk a bit more concretely about a potential problem. Okay, so let's suppose you want to decrease emissions intensity, but you still want to feed people. Okay, so what you could do is you don't want to kill off all of agriculture. Instead, you might want to invest in the relatively green or the transitioning agriculture firms. Okay, but if you pursue the strategy, you would have to be okay with the fact that relatively green agriculture is still going to be much more brown, basically have much higher emissions compared to insurance firms and other service sector firms. Okay, and further, you would have to be careful not to underweight all of agriculture as a whole in your portfolio. Okay. So what we see as a problem is, in reality, when we look at the aggregated holdings of sustainable investing funds, they are underweighting the entire agriculture industry by about 80%. Okay. We also want to acknowledge that many of these funds sector adjust. Okay, so they claim that their sector weightings equal the actual market weights of these sectors in the real economy, but they're sector adjusting at a very coarse level. Okay, so within a single sector, you might have both agriculture and drugstores. Okay, but clearly they're not producing substitutable goods. Okay. So to give you an example of the lack of industry adjustment that's been going on, this is a plot of SIC2 industries in terms of their emissions intensity against the extent to which each industry is overweighted in sustainable investing funds. Okay, and what we see is that entire industries, if they are high polluting, are underweighted by these funds. In the next plot, we're doing something quite similar, but we're only looking at the 20% of firms within each SIC2 industry that are the lowest emitters. So this is like the greenest subpart of energy, or the greenest subpart of agriculture. And what we find is even the greenest firms within high polluting industries are underweighted, or basically being punished by sustainable investors. So let me conclude, and I'm happy to kind of leave more time for discussion and Q&A. What our research is pointing out is the dominant sustainable investing strategy may be counterproductive, because by underweighting brown firms and rewarding green firms, what we expect to happen is the brown firms actually become more brown, but the green firms basically cannot become meaningfully more green because they've basically maxed out in how little environmental impact they can have. Okay. And we also show that sustainable investors mistakenly reward firms that are already green for large percentage reductions in emissions, when really they should be rewarding or incentivizing brown firms to make meaningful reductions in their emissions. Let me clarify that my co-author and I, we are not at all anti-ESG. We're not anti-sustainable investing. We're very, very concerned about the risk of global climate change. And our research is not meant as a critique of all sustainable investing strategies. What we're concerned about is that the dominant strategy seems to be motivated by a naive desire to reward the good firms and to punish the bad firms. Okay. What we hope would happen instead is that investor flows and engagement should actually target just brown firms, because they're the ones that matter for the environment. And it doesn't have to be an engagement strategy, which I understand can be quite costly for some funds to pursue. You could provide incentives by essentially overweighting brown industries and rewarding the relatively green or transitioning firms within those brown industries. Okay. Finally, let me just add that, so far I've been talking about sustainable investors as a group of people that want to affect change in the way that firms are run. Okay. So they have direct environmental goals. We also recognize that there's another set of investors who are drawn to ESG or sustainable portfolios because they want to minimize carbon transition risk in their portfolio. Okay, so essentially what they worry about is that there are some firms, maybe brown firms, that are at high risk of carbon taxation or other regulatory risk, and that this risk may not be priced. Okay, and essentially, if this is a risk that you're worried about, you're going to either avoid these firms in your portfolio or demand a higher expected return for you to be willing to invest in these risky brown firms. Okay. So, caring about carbon transition risk, fully rational. But what we'd like to point out is, to the extent that investors demand a higher return to invest in these risky brown firms, that's essentially going to push up their cost of capital, which could have this counterproductive effect of making these risky brown firms actually more brown. Okay. We also want to point out that the goal of mitigating ESG risk in your portfolio is very different from the goal of encouraging firms to transition toward green. Okay. If your goal is to mitigate ESG risk in your portfolio, that probably does mean divesting away or avoiding a set of firms that are high ESG risk. Okay. Whereas if your goal is to encourage firms to transition toward green, that probably means owning and engaging with the high polluting industries that actually matter for the environment. One last bit of evidence, and then I'll be happy to take questions. There's an important question, which I've sidestepped so far, which is whether sustainable investing has actually already changed firms' cost of capital. Okay, this is not the focus of my research, but I just wanted to briefly summarize where the literature is. Basically, there's active debate. Okay. So there's theory models as well as a clever study of the South African apartheid divestment campaign, which shows that there doesn't seem to be major changes in cost of capital. Okay, but there is also a growing body of empirical evidence looking at quite recent data that says that yes, because of these massive inflows into sustainable investing funds and these divestment campaigns, that green and brown firms now differ in their cost of capital by an additional 1 to 3%. Okay, I don't think this debate is settled yet. Where our research comes in is we'd like to point out that regardless of whether the cost of capital has already changed, if there's $40 trillion invested in growing in sustainable finance or ESG, it's really important to know what would happen if this movement succeeds in changing the cost of capital. Okay. Another way you can think about it is, suppose you could just push a button to change the cost of capital for brown firms. Okay. We really want to make people concerned about this idea of, do you actually want that cost of capital to go up? Okay. Because if you do, you're going to succeed in punishing these firms and pushing them closer to bankruptcy, essentially making them more short-termist. And we're worried that that could actually cause them to pollute more because they're so worried about generating cash in the short term. Okay. So let me end it there. I'm very happy now to take questions and just have a general discussion.
Brilliant. Thank you so much, Kelly. I think you make a really cogent argument there, which is, and very clearly set out, I guess, the counterfactual of what, as you sort of point out, where people are investing. I might kick off with a question, encourage anyone in the audience to put questions in the Q&A. But I see it here a lot with different colleagues from across industry, broad spectrum across academia, and they flat out do not want to be associated with brown firms. But you clearly make the point, if we're about emissions and emissions reduction, investing in these actually is a way to help support it. Are you getting the message across, or how can we get that message across to get people to think differently about this?
I do think divestment campaigns are quite problematic. I realize the intent behind the campaign is often an intent that I very strongly support, but I just worry that they're not just going to be ineffective, but they could be actively counterproductive. So I'll give you the example of, I'm associated with Yale University, which famously has a very large endowment. And we face, the Yale endowment faces pressure from stakeholder groups such as students and alumni all the time, demanding that we divest away from fossil fuel assets. And I wish these environmentalists would actually ask the opposite, okay? Because if Yale endowment divests away from fossil fuel assets, that means someone else owns them. And that someone else probably cares less about the environment compared to the Yale endowment, okay? If you're an environmentalist, I think a more effective strategy is you should actually ask Yale Endowment to buy fossil fuel assets and just sit on them, okay, and not use them. Or alternatively, maybe figure out a way to use them in a relatively efficient, environmentally friendly way. Okay. Basically, you want the people who care the most about the environment to own and operate the potentially high polluting assets.
Yeah, it's a great point. We often have that argument that the divestment actually ends up with a lower tier sort of company operating, which only has more negative outcomes for the environment more broadly in society. There is a question here from Tim saying, has there been any advocacy to change the dominant sustainable investing strategy?
Yes. So I think, sustainable investing is still relatively new and is an incredibly dynamic movement. So, I have been rather negative in this presentation about pointing out issues, but I think there's a lot of reason to be perhaps more optimistic than about the future. So certain alternative strategies that I think are very promising are, one is there's targeted project level financing. Including project-specific debt markets. So here, regardless of what the rest of your firm is doing, maybe you're a brown firm, as long as this particular project is green, you can get subsidized financing, okay? And there's also targeted venture impact funds and PE funds that are trying to subsidize the most promising types of green R&D. So I think that's all pretty promising. There's also increasing interest in engagement strategies. So engagement is owning, potentially high polluting firms, but voting your shares or engaging with the board. I think the complaint I've heard about engagement is that it's just very expensive to do for your typical small fund manager. And I think, that's certainly a limitation. There's been coordinated efforts now among many small funds to coordinate and use the same engagement advisor. So that's a way for small funds to participate in engagement without actually doing it in-house. The other thing that I'm rather optimistic about is the growth of these transition-oriented portfolios. So transition portfolios would purposely invest in the industries that have the highest emissions intensity. So that would be like energy, manufacturing, et cetera. But it rewards the set of firms within those industries that have credible transition strategies or have reduced their emissions intensity over the past couple of years. Okay. I think these transition strategies are great because they provide incentives to the set of firms that really matter. Unfortunately, certain investors and clients have criticized these transition stories because ultimately the portfolio of a transition strategy is going to have very high levels of emissions, right? And you have to be okay with that metric looking bad in order to provide the right incentives, I think.
Right. If you want to stop sharing too, we can probably see you better on the screen. This is actually a great question that's come through almost to follow up on that from Catherine Demansky, who said, thanks, Kelly, great paper. I know she and I have talked about this a bit, but my question is, and it's a bit like my second one, not all brown firms are the same. So how can investors differentiate between firms which focus on short-term cash versus long-term emissions reduction and green R&D? Greenwashing is rife in the industry.
Yes. That's a very real problem. I would say emissions intensity scope 1 and scope 2, while they are still measured with noise, those are at least more credible measures than, having a net zero pledge by 2030 or 2050. So one way to do is just look at the actual recent history of changes in emissions intensity. The other thing that I would caution investors to do is, you need to be careful not to reward firms that are able to reduce their emissions intensity through asset sales. Okay. Right now, sustainable investors actually are very openly rewarding asset sales because they want to divest themselves of fossil fuel assets and they want the public firms to divest themselves of fossil fuel assets. And I just think this strategy is in some ways quite silly because the asset doesn't disappear. Somebody else is buying it from them, right? So I would prefer that these public firms that are subject to shareholder pressure keep their fossil fuel assets and just operate them more efficiently or don't use them at all. But please don't sell them.
It's a really good point, and I think the argument you're making, I'm sure, will help some think. I actually wasn't aware of transition-oriented portfolios either. How do you find those when you're looking out into the plethora of investment? Are they actually companies that are advertising that they're running those, or?
Yes. So they often have the word transition in their name. I'm not going to endorse any particular
No, I'm not.
But I think that's the general metric. That's the general category. They're called transition portfolios. And I would also recommend not relying on an unfortunate metric, which is financed emissions. So one way that sustainable investors sometimes judge the quality of an ESG fund is they look at financed emissions, which is total emissions of the firms in your portfolio scaled by their market cap. And when an ESG portfolio has high financed emissions, it's accused of greenwashing or some kind of deception. When really, I think, that could be the sign of a transition-oriented portfolio. Okay? And further, funds that have low finance emissions, I think those are funds that are just loading up on service sector firms and also technology growth firms, which have very low emissions relative to current market value because they're not producing anything, right?
Yeah. Okay. So Rebecca Cutter, actually, it ties in. So if the climate leaders list focus on the wrong metrics, as you talked about percentage movements. Is there currently a better way that's available to assess the companies that are actually making the biggest absolute improvements and being able to reward these? And do you see evidence of this taking place? I guess a little bit. And she made reference to the Woodside AGM. I think I sent you something on that to say that was here in Australia, and they the shareholders actually rejected their climate strategy, 58% against it. So, yeah, any thoughts on that?
Oh, that's interesting. I'll have to take a closer look at that. The data is there. So in order to calculate a percentage reduction in emissions, the data for the starting point and the ending point exists. And I'm recommending a very simple change, which is instead of, if a firm goes from 1,000 tons per million to 900 tons per million, judge it by its 100 ton per million reduction, not by its 10% reduction. And notice, if you look at this reduction of 100 tons per million, it's already scaled by firm size. So it's already comparable across firms. There's no need to further take a percent.
Right. So just use that absolute as the thing. Okay. So Longvo asked an interesting question. Was the environmental impact measured as the firm's direct emissions, or are they also capturing emissions along the supply chains? So I guess that's something to bring in. Yes.
It's a very important question. So just to get everybody on board, Scope 1 is the direct emissions of companies from their operations. Scope 2 is through the energy that firms purchase, essentially. And then Scope 3 is all the other emissions all along the firm's upstream and downstream supply chains. What we've done in our analysis, and this matches approximately what almost all sustainable investing funds do, is we currently only consider Scope 1 and Scope 2. It's not that emissions along the supply chain don't matter, but it's just a major measurement challenge, because we would have to chase down all the firm's suppliers, including in developing countries where the data is poor, and try to aggregate that up. And there's also this issue of double counting, because one firm's Scope 3 is another firm's Scope 1. That said, Scope 3, I don't see in the near future usage of Scope 3, just because I can't see a path for getting that data quality to improve. But it is important. Some firms that are considered quite green because they have low Scope 1 and Scope 2 emissions. So let's take a financial services firm or an insurance firm, right? They pollute very little directly through the nature of their business, but they essentially have massive investment portfolios. They own other companies, so they could have like a very large energy portfolio. Okay, so some ways they are actually very exposed to emissions, indirectly support it, but we're not looking at their Scope 3.
Yeah, and that makes sense. So this question's from Belinda Wade. She says, thanks, Kelly. We totally agree we need to focus on cumulative emissions and the decarbonisation trajectory of brown firms rather than emission intensity. Have you engaged with ESG funds on altered metrics which can be used for assessing investment options?
Yes. So what Sam and I are working on for our next project, and we would encourage anybody else to do the same, is we're trying to create a ranked list of firms that are improving in the right units. It's not going to be the perfect list because maybe they're improving on other dimensions, but we're just going to look at, are they reducing their emissions per unit of output, not on percentage levels, but just in the right levels.
And what's been the response of these ESG investment firms to some of the things that you're promoting here?
I would say in general, the response has been very positive by fund managers. And in fact, a lot of the responses, and I love this, they say they've been thinking about this for a very long time along the same lines. However, they are facing just enormous pressure from their stakeholders. And sometimes it could be a minority of their clients, but these clients just really want divestment, or they really want low total emissions in their portfolio. So they're having a hard time dealing with those demands. I think the other, I would say, slightly negative response that we've gotten is from certain people within the ESG movement that are worried that our research is going to be used as a talking point for anti-ESG. And I think I can see where that concern is coming from. But I do think it's important for even advocates of ESG to examine their strategies critically and try to improve.
And I think, again, advocating for looking at the real evidence as opposed to weighted averages and percentages and those sorts of things, which I guess gives you that. So Tim Bateman actually it's building on that. Do you feel that environmental and conservation groups are aware of this issue and the need to focus more on the transition portfolios?
There is both progress and lack of progress. Okay, so on the one hand, these impact-oriented targeted strategies are growing in popularity. But on the other hand, divestment campaigns are also growing in popularity. So take what's happening in green debt markets. Green debt used to be quite targeted. So a lot of it was project-specific financing in the form of incentives for basically subsidies for green investment. But now a lot of banks and credit suppliers are under pressure to divest away from entire companies, where the sin is at the company level, no matter what the company does on particular projects.
Yeah, it's interesting. I mean, I think even your reference to, Yale University investment, we have there's all that conversation that happens, I think, probably at every university across Australia. And some have proactively diversified away and got out of them, whereas others, I think, are taking a harder line. But the interesting one that you sort of suggest, will just sit on it if that's all that you do. It's actually, maintaining that investment and cost of capital and so forth. One of the things I'm interested, I was at a finance workshop in Cambridge. It was many years ago now, before COVID even, but it was really looking at this sort of a shift in young investors, sort of, who in the UK were the young lords that had lots of money and were putting them into funds, right? But I guess my question is, do you see anything? It's probably beyond the scope of your research, but how age or is influencing people's thoughts on this at all? Does that come up at all in any of the work, or even sort of alongside around how people are thinking about this challenge?
I haven't looked at this directly. I believe I have seen research that younger and possibly more middle-aged demographics are the most concerned about global climate change. It kind of makes sense, although we might all care because of our grandchildren and their grandchildren, et cetera. The biggest variation I have seen is really across political lines and by countries rather than age groups.
Okay, that's interesting. So I guess there doesn't seem to be more questions, but if anyone does, feel free to put them in. I mean, in thinking about closing this out, what is the message that we could take away, the people listening here and others that will dial in, to try and raise awareness of this and to sort of have those stronger, tougher conversations? Because if we, as you say, we're all about reducing emissions, anyone that cares about climate change, and this sort of idea of actually, we do have to live, so we need food and we need energy and all of that. What's the thing that we could do to take that and try and raise the bar on this discussion, I guess?
I would encourage investors to really think about this from a more practical, realistic, and consequentialist framework. Where I see the origins of the ESG and sustainable finance movement is really on a deontological basis, a rather naive deontological basis, which is this idea that basically associating with these bad actors is just fundamentally wrong. These firms have sinned, and therefore I don't want them in your portfolio, in my portfolio. And I think that makes sense for certain perspectives. Like, for example, people of certain religions don't want to associate with firms that do something that violates their religion. Okay. And it's not so much that they want to affect change. It's just, it is against their personal moral principles to associate themselves with these actions. But I would say for the majority of sustainable investors, they're hoping to affect change, right? So they need to go beyond this kind of naive deontological perspective and say, even if I don't like these firms, I need to think through the consequences of my investment choices and whether that's going to help me achieve my desired environmentalist goal. And unfortunately, I think that means engaging with and providing the right set of incentives for a set of firms that you may personally not like right now. But that's the way to affect change.
Yeah, and I guess I'm here at the Institute for Energy Transition. Our sort of rationale is actually trying to find those companies that are meaningfully trying to transition, and then how can our research help to support those? And I think, you know, exactly that's what your work seems to be pointing to in a different way from the investment. Look, Kelly, thank you. I realise it's quite late for you over there, but thank you so much for taking the time to share this. I think it's a really important message to communicate. We will, if it's with your permission, we can perhaps make access to the paper and also your slides and so forth, and we'll publish this webinar. But feel free to keep in touch. If you're ever coming down this way, we'd welcome you to Perth in Western Australia, because I think the messages that you've got is so important as we really try and navigate this transition to net zero, wherever that might be eventually moving forward. So I really appreciate your time. So thank you.
Oh, thank you very much for this opportunity.
Yeah.
Take care.
All right. Take care. Good night for you. Thank you. Thanks, everybody. Bye.